Hi, I am Anna. I come from www.ntvforex.com. œHard timesâ warning for UK after economy contracts 20% in Q2 analysis. http ntvforex.com news ID 778205 8/12/2020 8:09 European markets have seen a mixed open after the latest UK Q2 GDP showed a record contraction for the UK economy. This doesn't appear to have stopped the FTSE 100 from leaping out of the blocks, as it outperforms its European peers, with the DAX slightly lower, with SAP and Infineon acting as the main drag. The pound has shrugged off the GDP numbers, which showed that the UK economy contracted by 20.4%, as a result of the lockdown of the economy at the end of March, and throughout April. While the headline GDP number will grab all the headlines, along with the inevitable hyperbole about unprecedented drops in output, the UK is hardly unique in this regard, with countries across the world all seeing record declines in economic activity. The likely reason the Q2 drop was higher was probably due to the fact that the UK went into lockdown later than its European counterparts, and also came out later, which means the total effect was more concentrated in a single period. Since then the picture has improved somewhat. However, trying to distill the impact of an economic shock of this magnitude into a single number is always like to present challenges. It is true that the picture has improved in recent months, however the ripple-out effects are likely to resonate for months and years into the future, and that's even before we even consider the unforeseen human costs of higher structural unemployment as the economy attempts to recover from this once-in-a-lifetime shock. It does appear that Chancellor of the Exchequer understands this, as he warned this morning that hard times lie ahead, with the prospect of further large-scale impacts in the weeks and months ahead. UK construction giant Balfour Beatty swung to a first-half loss of A24M due to the coronavirus shutdowns in Q2, sending the shares lower in early trade. Despite this morning's early losses, the overall picture appears to be a positive one, with a decent increase in revenues of 6% to A4.1 bn, while the total order book improved to A17.5 bn due to the various cost-saving measures implemented by management. Due to the pandemic, the company's net cash position improved to A563m. It's been a good first half for Just Eat Takeaway, which saw revenues surge in the first half to A675m from A179m, as orders rose by 32%. Due to the various economic lockdowns. That didn't stop the company posting a first-half loss of A158m, though this was largely driven by the various associated costs related to the recent merger between the two companies. It's also been a decent H1 for Admiral Group, which has seen a 30% rise in pre-tax profit of A286.1m, despite a fall in first-half turnover of 4%. After the company pledged to repay A100m to its customers since they weren't driving as much as they used to, due to lockdown restrictions. The company also pledged to pay a dividend of 70.5p a share, which included the payment of a 15.5p special dividend, which has seen the shares rise to the top of the FTSE 100. ASOS shares have hit their highest levels since December last year, after the company said they expected full-year revenue growth to be between 17% and 19% higher, with profit before tax to be in the region of A130m and A150m. It's not been such a positive first-half update for MMG plc, the UK company formed out of the demerger from Prudential, with assets under management falling to A339m at the end of June, as a result of the recent market turmoil in Q2. Operating profits also fell to A309m, down from A714m the previous year. Investors don't appear to be that concerned, however, while management said they would be paying a dividend of 6p a share. The longer-term focus appears to be on the completion of the eccentric deal, which is set to introduce billions of pounds of new assets under management, on a IFA wealth management platform. Gold prices appear to be stabilizing after their sharp falls of the last few days, after selling off sharply in the face of rising U.S. yields. U.S. markets look set for a more positive open after yesterday's sharp sell-off, with the main focus set to return to a raft of earnings announcements, from the likes of Cisco Systems, Vroom, and LYFT. We also have the latest US CPI numbers for July, which, after the surprise rise in PPI numbers yesterday, will be scrutinized carefully for similar signs of a rise in inflationary pressure. Of particular interest will be Vroom's first quarterly report as a publicly listed company, after its IPO launch in June, and progress so far has been solid, burning rubber off the starting grid, rising from an IPO price of $22 to close at $47.90 and a market cap of $5.52 billion on its first day of trading. The enthusiasm for this new online car ordering and delivery site has shown little signs of waning in this new COVID-19 world, with shares trading up near $60. The progress and enthusiasm is all the more remarkable given that the company isn't even close to being profitable. The company has never made a profit since it started in 2012, last year it lost $143 million, and lost $41.1 million in the first quarter of this year, while sales rose to $375.8 million in March. The enthusiasm here appears to be based on the premise that clients would be happy to buy a car without test driving it, checking how it drives, the quality of the finish and how it looks inside and out. This seems a tough ask, however we already know that how the market values a business bears no relation to whether or not it actually makes a profit. Losses are expected to come in at $0.73 a share. Dow Jones is expected to open 240 points higher at 27,927. S&P 500 is expected to open 22 points higher at 3,355. Subscribe our channel to receive the news as soon as possible. Thank you for watching. If you want to read real-time news, text messages to MT5 Expert Advisors page at https://mt5.expert.advisors.